I'm going to do a demonstration of some of the decision techniques and rules that we utilize in the course to determine whether a project that we're considering for the firm is acceptable or not. So by projects, I'm referring to fixed asset investments in the firm, such as equipment or machinery. And we would want to implement those fixed assets to reduce our firm's cost, increase our revenue and profitability, or most likely both. So sometimes these investments would be to replace equipment that is maybe outdated or obsolete, or maybe it is equipment that would be new to the firm that we would be looking to utilize to grow the company. So I'm going to utilize the cash flows that we show here in column B. Realize we have 6 years of future cash flows and that all of the figures are different. So whenever we are looking at cash flows that are different in value, and it could be a range of values that are all the same except for maybe one figure, so maybe all these figures were 15,000 except for year 6. Whatever the case may be, we consider that to be a mixed stream. We know that from previous time value of money studies that cash flows that are different, or at least one figure is different, is considered a mixed stream, and we can find the present value of that mixed stream most efficiently by using the NPV function in Excel. So let's start that here with cell B11. We utilize the NPV function, and with the rate, I've got a cost of capital, as we can see up here, of 9%. So I'll put 0.09, or I could have used a cell reference to D1, either way. For the individual cash flows, I can input cell references to each of those future cash flows in each value box, or I could input, of course, the actual dollar amounts. But the most efficient way to input a range of cash flows is just to utilize the first value field and highlight the range of values. So this will use cell references. So in this case, B4 to B9. So highlighting all the future cash flows in that first value box. And that's the quickest way to get our net present value of those cash flows. So in this case, we have 109,958, which again, to make sure we're understanding what we're calculating, this is the present value of those future cash flows. This is not the answer yet of what's the net present value of our project that we're considering. In order to get the net present value of the project, we need to factor in the upfront cost, if there is one. So in this case, we have a $100,000 initial investment that would be required at year 0 or present, or at the current time before we make the investment, or we can anticipate those future cash flows. So I need to subtract out that $100,000 cost. So to do that, very simply, just subtract that from our present value of our future cash flows. I use an addition sign because the cost is already shown with a negative. So just netting the two figures out, I would have a net present value of this project of 9,958. We know that that's acceptable because it's a positive value. So with the decision rules that we work with in the course, there's not much subjectivity to it. It's economically black and white speaking. It is either accept or reject, depending on whether the value is positive or negative. Okay. Now, the other decision rule that we work with quite a bit is internal rate of return. So internal rate of return is a way to utilize a percentage rate of return metric instead of a dollar amount. So a lot of managers prefer to use rates of return as opposed to maybe longer dollar amount figures. So in this case, we could find the internal rate of return by utilizing the IRR function. So I can add the IRR function. The nice thing about IRR is that we do, for this one, include the initial upfront cost if there is one. So it's important that we, when we utilize IRR, that we have our cash flows listed properly with any negatives, typically going to be that first figure, and then we include that in the range that we select for the values field. Okay, so in this case, I'm highlighting the upfront cost all the way through the future cash flows. And I come back with 12.15% as my internal rate of return. Now, sometimes your result may come back with most of the time in Excel, it'll come back with a whole number. So just make sure that if you need an answer to typically 2 decimal places, that you come up and add a couple of decimal places to your answer. So how do we know if this is acceptable or not? Well, the internal rate of return in this case is greater than our cost of capital. So that is kind of the benchmark we use for the rule. If internal rate of return is better than the cost, then that is an accept decision. So net present value is accept, and internal rate of return is accept as well. Now, there are cases occasionally where you might find that your decision rules conflict with your answers here. So we may have a case where maybe the net present value was positive, but the internal rate of return was slightly lower than the cost of capital. So in that case, it would be an accept based on NPV, but reject based on IRR. And when that's the case, the net present value is kind of wins out in that scenario. So if you get basically a final answer of do we accept or reject this project, as long as the net present value is positive, that's what we'll lean on. So it would be accept if the two decisions were to be in conflict. Okay? So with internal rate of return, just be mindful that it's really, by definition, is the rate that makes the net present value of the project equal to zero. Or we might say that it is, another way to say it is, it's the rate that sets the present value of the cash flows, or this figure here, equal to the cost, in this case, $100,000. So when it comes to working with internal rate of return, again, it's a way of utilizing rates of return, but we're still operating within the cash flows, the present value of the cash flows, and the cost, same figures that we utilized for net present value. But of course, with internal rate of return, we need to lean heavily on the IRR function, because the formula to try to find this manually would be very long, because you'd essentially be guessing using guesstimates within the manual formula to try to determine or narrow down what that rate of return would be. So this is definitely a case where utilizing the IRR function in Excel saves a massive amount of time than trying to work with a manual formula. All right, the third decision rule that we utilize is profitability index, and this one is really just a way of reshuffling some figures that we've already calculated. So profitability index, again, just a different metric. Instead of using dollar amounts or rates of return, it's just using a ratio. So we're going to take the present value of the cash flows that we've already calculated along with the cost, and we're just coming up with a ratio based on those two numbers. So what we say with profitability index is just equal to the present value of the cash flows and divided by the cost. So to calculate it, we're just going to take the present value of the cash flows, and I use actual figures so you can see it a little bit easier. So 109,958, again, we've already calculated, and divided by our cost figure as a positive number. So we're not using a negative number as the cost. So the profitability index would just be 1.1, again, utilizing the same two figures that we've already determined. So the rule on this one is just that if the profitability index or the ratio is greater than 1, then that's an accept decision. If it happens to be lower than 1, so 0.99 or less, then we would reject the decision. And you can see, if you think about the dollar amounts that we're utilizing, a pretty easy ratio to see ahead of time whether it's going to be accept or reject, because the present value of the cash flows in this case is more than the cost of 100,000. So we've got, just like we saw with the net present value of the project, we have a positive net present value, but more importantly, the present value of the cash flows is greater than the cost. So we know that if the present value of the cash flows is greater than the cost, it's going to be accept, but we can actually calculate a specific ratio so we can put it in numerical terms, in this case 1.1. All right, and then the last decision rule that we utilize is payback period. So with payback period, it's very, very easy if the cash flows are all the same. So if the cash flows are the same, in this case, let's imagine that all these cash flows were $25,000 every single year. Okay, so if the cash flows are the same, then it's very easy to calculate just because we take the cost divided by the cash flow, and we're done. Okay, so in this case, we would say $100,000 divided by the 25, if it was to be $25,000 every single year, then our payback period would be 4 years, and that would be it. Okay, so that's a question you want to see on the exam, of course, because that's an easy formula to utilize. But when we are working later chapters with decision techniques, we're typically dealing again with mixed streams of cash flows here. So here we've got to do a few other steps, do a little bit more work before we can actually narrow down the payback period with the cash flows that were given in this example, or my example. So the way that we can do this, there are really a couple different ways. Excel projects in the Pearson lab will show you a way of just backing down the cost to get to a payback period. The way I like to demonstrate it is utilizing cumulative cash flows. Okay, so what do we mean by cumulative cash flows? Well, we're referring to how much cash flow in total have we experienced up through that year. So after year one, where we received $15,000 in cash flow, we would have, of course, $15,000 of cash flow. After year two, we would have experienced $15,000 in year one plus $20,000 in year two. So in this case, we would have cumulatively $35,000 of cash flow through year two. Same through year three. Years 1 through 3 in total would give us $70,000 in cumulative cash flows. And then finally through year 4, if we add another $40,000 to our dollar amount here, we would be up to $110,000 of cumulative cash flow. So as we do these cumulative cash flows, what are we actually looking for? What's kind of at what point does the light switch go on and say, oh yeah, I'm done calculating these figures? Well, we're looking for the year in which our cash flow our cash flow provides a payback within that year. So we're working with an initial investment of $100,000. So we're trying to find out in which year does the payback period actually occur in. So looking here, we can see that in year 4, we have cumulatively acquired $110,000 of cash flow. So the payback period occurs sometime in year 4, okay? So we need to know, okay, well, what is the actual specific numerical payback period? It's gonna happen sometime in year 4. So what is that number? Well, we could say then that the payback period is gonna happen in 3+ years, right? So 3 full years it takes, plus a part of year 4. Okay, so we've narrowed it down to the payback period is 3 point something because we need all 3 years we need all of the initial 3 years of cash flows plus part of year 4. So how do we then find that partial year in order to determine the exact numerical payback period? So the way that we can do that is we can start with our cost figure. So again, we needed $100,000. And through year 3, as you can see, we generated $70,000. So that means that we are needing $30,000 more of cash flow to exactly pay back that initial $100,000 cost. Okay, let me say that again. So our initial cost was $100,000. After year 3, we've accumulated $70,000 total of cash flows. So the difference is $30,000. I need $30,000 more dollars to pay back my initial $100,000 cost. All right. Now, where is that $30,000 of additional cash flow going to come from? Well, it's going to come from year 4 cash flow. What is year 4's cash flow? Excuse me. Well, year 4's cash flow is not 110. That would be the cumulative through year 4, including all 4 years. Year 4's cash flow is $40,000. So I'm going to divide that essentially $30,000 here that we have in the numerator by the $40,000 cash flow that we generate in year 4. Okay, and that gives us 0.75. So the partial year, so how much do we need of year 4? Well, we need 3/4 of year 4's cash flow to exactly pay back the $100,000 cost. So what is that final then payback period figure? Well, it's going to be the 3 full years of cash flow plus that partial year of cash flow. So the answer in this case is 3.75. And with that, I hope that this overview has helped you. You'll need to be able to calculate on the final exam, certainly the net present value of a project, the internal rate of return, and payback period. Now, payback period, you could get questions that have cash flows that are the same, which in that case we refer to as an annuity. So the example I used earlier with assuming all the cash flows are $25,000 each year, or you could expect questions that are utilizing mixed streams of cash flows like we did in my example here.